Good morning, my dear students. Today we are discussing about aim of finance function, scope or content of financial management, and relationship of financial management with other discipline. First of all, we are discussing about aim of finance function. The primary aim of finance function is to arrange as much funds for the business as are required from time to time. The finance functions has been classified into four. They are acquiring sufficient funds, proper utilization of funds, increasing profitability, and maximizing firm's value. The first functions of finance or finance function is acquiring sufficient funds. The main aim of finance function is to assess the financial needs of an enterprise and then finding out suitable sources for raising them. The second finance function is proper utilization of funds. Though raising of funds is important, but their effective utilization is more important. The funds should be used in such a way that maximum benefit is derived from them. The returns from their use should be more than their cost. The next finance function is increasing profitability. The planning and the control of finance function aims at increasing profitability of the concern. To increase profitability, sufficient funds will have to be invested. Finance function should be so planned that the concern neither suffers from inadequacy of funds nor wastes more funds than required. The last finance function is maximizing firm's value or wealth maximization. Finance function also aims at maximizing the value of the firm. It is generally said that a concern's value is linked with its profitability. Now we are discussing about scope of financial management. In the previous class, we are discussing the scope of financial management on the basis of two approaches, that is traditional approach and a modern approach. Here we are discussing the scope of financial management on the basis of area covered. Then the scope of financial management is classified into 7. First one, estimating financial requirements, deciding capital structure, selecting a source of finance, selecting a pattern of investment, proper cash management, implementing financial controls and proper use of surpluses. The first scope of financial management is estimating financial requirements. For this purpose, the financial manager will prepare financial plan for present as well as for future. The amount required for purchasing fixed asset as well as the need of funds for working capital will have to be ascertained. Then the second scope of financial management is deciding capital structure. After deciding about the quantum of funds required, it should be decided which type of securities should be raised. A decision about various sources for funds should be linked to the cost of raising funds. If the cost of raising funds is very high, then such sources may not be useful for long. A decision about the kind of securities to be employed and the proportion in which this should be used is an important decision which influences the short-term and long-term financial planning of an enterprise. The third one is selecting a source of finance. Various sources from which finance may be raised include share capital, debenture, financial institution, commercial bank, etc. etc. If finance are needed for short period, then banks, public deposits and financial institution may be appropriate. On the other hand, if long-term finance is required, then share capital and debenture may be useful. The fourth one, selecting a pattern of investment. The funds will have to be spent first on fixed asset and then an appropriate portion will be retained for working capital. The decision making techniques such as capital budgeting, opportunity cost analysis, etc., may be applied in making decisions about capital expenditure. Next one, proper cash management. Cash management is also an important task of finance manager. The cash management should be such that neither there is a shortage of it and nor it is idle. Any shortage of cash will damage the creditworthiness of the enterprise. The idle cash with the business will mean that it is not properly used. The next one, implementing financial control. An efficient system of financial management necessitates use of various control devices such as return on investment, budgetary control, break-even analysis, cost control, ratio analysis, cost and internal audit. Then last one, proper use of surpluses. The utilization of profit or surpluses is also an important factor in financial management. A judicious use of surpluses is essential for expansion and diversification plan and also in protecting the interest of shareholders. Next, we are discussing about relationship of finance with the other business functions or discipline. Business function means financial activities that an enterprise undertake in achieving its desired objectives. Finance function of a business is closely related to its other functional areas. Funds will be wasted in the absence of efficient production and in the absence of proper marketing. Financial policies of a firm should be devised in such a manner so as to match the requirements of other functional areas. The relationship between finance function and the other business functions of an enterprise is discussed below. First one, purchase function. Material required for production of commodity should be procured on economic terms and should be utilized in the efficient manner to achieve maximum productivity. In this function, the finance manager plays a very important role. Second one, productivity function. Production function occupies the dominant position in business activities. The production cycle depends largely on the marketing function because production is justified when they are resulted in revenue through sales. Production function involves heavy investment in fixed asset and in working capital. Naturally, a tight control by finance manager on the investment in the productive assets become necessary. Third one, distribution function. As goods produced and meant for sale, distribution function is an important business activity. It is more important because it provides continuous inflow of cash to meet the outflow thereof. So while choosing different distribution channel, media of advertisement and sales promotion technique, the cost benefit criterion should be the guiding factor. Fourth one, accounting function. All the accounting tools and controlling devices necessary for appraisal of finance policies can be correctly formulated if the accounting data are properly recorded. The efficiency of the whole organization can be greatly improved with correct recording of financial data. Fifth one, personal function. No business function can be carried out efficiently unless there is a sound personnel policy backed up by efficient management of personnel. A sound personnel policy includes proper wage structure, incentive scheme, promotional opportunity, human resource development, and other fringe benefit provided to the employees. All these matters affect finance. Next, research and development. In the world of innovation and competition, expenditure on research and development is a productive investment, and research and development itself is an aid to survival and growth of the firm. However, sometimes expenditure on research and development involves a heavier amount. disproportionate to the financial capacity of the firm. So there must be a balance between the amount necessary for the research and development and the funds available for such a purpose. Last one, financial management and economics. Financial management draws heavily on economics for its theoretical concept. A financial manager has to be familiar with two areas of economics, that is microeconomics and macroeconomics. A firm is also influenced by overall performance of economy as it is depend upon the money and capital market for the procurement of investable funds. The finance manager should recognize and understand macroeconomic theories, monetary and fiscal policies, and their impact on the economy as a whole and the firm in particular. Thank you.